What is up, everybody? Welcome back to the Run Your Mouth podcast. I've got my good friend, Gene Epstein. I think this is a fifth or sixth appearance on the Run Your Mouth podcast, and it's always a pleasure.
Yeah.
Thank you for taking the time.
It's always a pleasure to run my mouth with you, Rob. Although, again, as a matter of fact, I mentioned to you that there was some fan of yours who actually began by saying, Gene Epstein is extremely insightful, but he's hard to listen to. And so I wrote the person back and said, thanks for the thumbs up about my insights, but is it Rob's fault that I'm hard to listen to? Probably so. I don't know.
I think that guy just didn't understand Gene, which is we have you on for your good looks. Look at this Mr. Rogers sweater that you have on in this fine office setting. That's why we bring on Gene Epstein.
And that's why it's so hard to listen to me, Rob, because
we're distracted by your incredible attraction. Yes.
See, I guess you've explained it, Rob. I just want to start off by offering.
Let me tell you. Wait, I do have to tell you though. You got to take the comments in stride. If I paid more attention to the part of the problem YouTube comments, I'd be I would have regrown my hair, gotten a wig, quit the show, talked more, talked less. So you got to just mostly ignore the comments.
Yeah. No, I know. But this was a high compliment followed by an insult. So I thought it was special. Usually you just get consistent insults or consistent compliments, but that's the only reason why I found it especially interesting. But you're right, Rob. And of course, look, although as of course it's like the podcasts feed on themselves because Dave and you spend a lot of relatively entertaining time making fun of so many other podcasters. And most recently, Dave was, of course, talking about his critics. So it's an interesting counterpoint. So, of course, Dave was responding mainly not to obscure people, but to podcasters. So that is a little bit of a difference, but often to idiots. And I'm amazed. The Manhattan Institute is making Ben Shapiro their intellectual of the year. The Manhattan Institute,
someone's got to give out the propaganda awards. When you get out there every day and you do the good, honest, hard work of deep state propaganda and you shill for the Israeli regime, someone's going to give you an award for it. So I guess this year it's the Manhattan Institute.
Ben is out of his goddamn mind. Although I do admire, I do think he's probably the fastest talking Jew I've ever met. He manages to get maybe about 5 words in every second of time, and you can actually make them out. I always say slow down for people, and matter of fact, I am going to slow down. Although of course they can always adjust it on their own phones.
I think Ben's trying to crowd your mind. You know what I mean? He's trying to crowd your mind. He's like a boxer with a quick jab. He just keeps throwing so much information at you that you can't quite absorb that it's stupid.
The last of the great Jewish heavyweights. That's Ben Shapiro.
Exactly.
Anyway, all right, now that we've insulted a fellow Jew, what else? I guess this is what I'll do, Rob. I'll follow your lead, your questions, and then if you've left anything out, which you probably will, then I'll take over. So Rob, you'll run the interview for the first half, then I'll ask myself the really important questions in the second half. Go ahead.
Excellent, Gene. Yeah. I agree to your terms. So, all right, I have a bunch of questions that were top of mind that I wanted to get into with you. Yeah. I like Gene off the hip, so I did not give you advance warning on any of these questions. You're welcome to skip any of them, plead the fifth on any of them. But I'm excited to get your insight.
I'm not going to pretend that I know something that I don't know. Go ahead. Yeah.
That's my whole radio career. So, there's still time to become a podcaster, Gene. Feel free to.
You are an essential second banana to Dave Smith. You bring him alive. He does, as I mentioned to you, he does a good job when he's solo. He does a better job when he's on with you.
Thank you, sir. Yeah. All right, so let's start with this. We got some shenanigans over at the Federal Reserve.
Oh my gosh.
Donald Trump is trying to unseat Powell. He's also running interviews to make sure that whoever comes in next is going to lower the interest rate for him. He's trying to flip governor seats. He really wants to make sure he's got full control over the Fed and make sure that they're pushing interest rates lower. So I'm curious to know, if Donald Trump had full control over the Fed, how low can he even push interest rates in this environment? And what's going to be the effect? Like, what would be the effect if he pushes it to 3, 2, 1, 0? And what can the market even sustain by way of even being able to sell bonds at those levels?
Oh, I see. Well, okay. First, I'm just for starters, I do want to question the premise of your question. Based upon everything I'm reading in the financial press, you know, I don't hang out. I'm not one of those courtier reporters who hangs out at the Fed in Washington, D.C. and gets the scuttlebutt. However, and I never, of course, wanted to do that, but those who do point out that the decision is made by the Federal Open Market Committee, as it's called, the FOMC. The decision to raise or lower or keep the same the target interest rate, which is known as the federal funds rate. And all of the evaluations from those in the know at the Wall Street Journal, certainly, and the New York Times, which is the two mainstream publications I read, I think you should expunge from your vocabulary the word corporate, because there's nothing wrong with corporations. The mainstream media, the legacy media, the New York Times, the Wall Street Journal, they say that perhaps you know that any vote on what you're going to do with respect to the Fed funds rate, the short-term interest rate, has got to be one man, one vote, or one woman, one vote among the 12. And the funny part is that you ask, well, there are 12 people. What if there's a tie? What if it's 6 versus 6? And in fact, that has never happened. Sometimes it's 7 versus 5. But the point is that whoever he appoints as chairman, and of course, you actually put it in more tentative terms, it's clear enough that Powell is out and that he's going to appoint his own person to the Federal Reserve. The first problem will be that he might not get that appointee approved by the Senate. So that's the first problem. And secondly, even if that does happen, the appointee will only have one vote. And it looks as though the majority of those on the FOMC who are likely to be on it are at least by 7 or 8 votes going to overrule. So I'm only saying that because I think it's important at least to be realistic about your question. However, I will take your question. And your question, of course, is, let's say that Trump does manage to, let's say, make Rubio his chairman. Rubio has all those other responsibilities, but he doesn't do batshit with any of the rest of it. So Rubio becomes Fed chairman. Or let's say Trump just appoints himself Fed chairman, or perhaps he puts Ben Shapiro on as Fed chairman. No, Ben is a bad example. But anyway, okay. So then the FOMC does lower interest rates. However, the error you're making in your question is to forget the fact that the FOMC's specific target and specific power is only over what's called the overnight interest rate, the federal funds rate, which is the rate at which banks borrow from each other. I could go into how, if it decides to lower the target, how it has the power to do so. There's actually some dispute among economists about whether the Fed really has to use any muscle to lower the overnight interest rate, the federal funds rate. It can simply declare it, and the banks will behave and trade at a lower rate of interest. If it doesn't succeed by declaring it, there are other ways of manipulating the federal funds rate. But the point then is that we're only talking about the short-term interest rate, which does affect the 1 year, the 2 year, the 3 year rate. It does affect the 5 year rate and has some effect on the 10-year rate, the mortgage interest rate. However, we're now talking about what is called a yield curve. The yield curve takes it is over time. It measures the interest rate on the vertical axis and the term of each loan on the horizontal axis. So the yield curve would be that the federal funds rate, say, is lowered from 2% to 1%, but there could be a lot of resistance along that yield curve, and the 5 year rate and the 10-year rate might not budge. There used to be a term called the bond vigilantes. It's funny that it's gone out of style. What the bond vigilantes did in the 90s, especially, and that's when they were called bond vigilantes, is that if the Federal Reserve wanted the 5 and 10-year rate to be lowered, they would start selling bonds. So if you start a lot of selling of bonds, then that means that the interest rate on those bonds goes up. And if that happens, then again, Trump's whole idea might be foiled. So if you recall, you asked, well, how would the market be screwed up by much lower interest rates? The answer is that worst case, probably the 5 and 10-year rate will not be hugely affected. But even if they are hugely affected, then they're not going to go down to a level that nobody will borrow or lend at. But what will happen? Okay, well, I want to answer what will happen is, of course, the potential of a short-term boom because money will be cheaper, but that will probably lead to greater instability over the long run. So the punchline is, of course, that if Trump succeeds in what he wants to lower interest rates all along the yield curve, then that will mean cheaper money. That will cause malinvestment, greater speculation, and bad news. But in the short run, it might give the economy a little bit of surface oomph. And of course, Trump is very much a short-term thinker. So I think I've answered the question, Rob, but do you have a follow-up?
I do have a follow-up just to give people the quick short on that.
Yeah.
You don't think that Donald Trump is actually able to manipulate basically the Federal Reserve process, and because he doesn't have control of the whole board, you don't think that you're not buying into that Donald Trump is going to be able to force the interest rate lower? And if he does force the rate lower, it can't be not in line with basically the demand for debt at those prices.
Well, okay, interest rate. You understand that when you talk about an interest rate,
yes,
I'm putting a fine point on it, and I'm talking about a yield curve. I'm talking about the overnight interest rate, that's the federal funds rate, the 1 year, 2 year, 5 year, the AAA bond rates, all of them generally follow a curve so that 10 years out, 15, 20 years out, the rates start to rise. So the first point I made is that based upon everything I'm reading, there may even be some problem that Trump will face getting the Senate to approve his appointee. Second, even if he does, I tried to point out to you that all of the analyses and polls of the 12 people who serve on the FOMC, including the Fed chairman, means that the other 11 would have to go along with what Trump's man wants. and now I have to look it up, but I believe that maybe, of course, these people are also, well, these people are presidents of Federal Reserve. I don't think that Trump in next year or so can pack those other 11. He has a couple of potential appointees, but I think they're still in place. And therefore, the Federal Reserve chairman Trump appoints would have to get 7 votes out of 12, 6 more votes in order to get that done, just to lower the short-term interest rate. So therefore, but even if that happens, it's unpredictable as to what will happen to the 5 and 10-year rate. I'm saying, okay, those rates will probably lower somewhat. Let's grant that, so Trump will get his wish. The short-term interest rates goes down, the 5 and 10-year interest rates go down for the corporate bonds as well, and he gets a bit of a boom. But as a Austrian economist who believes that the Federal Reserve, of course, should not be in charge of the price of credit, the most important price of all, but arguably in the market economy is not the salary that Rob Bernstein gets to work run your mouth, or to work part of the problem. It's the price of credit. And the idea that we have this Soviet-style planning with the Federal Reserve has any influence at all. These 12 wise men are supposedly wise enough to influence where the price of credit should be. That's obviously harmful, and clearly the market will work out the best interest rate that suits creditors and borrowers based on time preference, based on the demand for funds. So, of course, the whole damn thing should be scrapped. I digress when I say that. Going back to, I'm scrapped because if Trump gets his way, it will only do harm.
Okay, so
not in the short run. He'll get some money in the short run, but it will only do harm down the road, because I think that the interest rates that we do have are already on the low side. That's my best guess, although, of course, we don't really know. We can only approximate it because we don't have a market. By and large, we don't have market-determined rates of interest. We have far too much interference by the Federal Reserve in order for us to really know what the proper interest rate would be. My best guess is that it's on the low side already, low so that it could unleash instability.
Now, when you say low, do you think it's like 3? Do you think it's like, what's it currently at, like 4 or something like that? Like, do you think it should be at 7 or 8? Do you think it should be at 4.5? How low do you think it is relative to where it should be?
Oh, well, you're referring to the federal funds rate specifically.
Yeah.
Is that right? Yeah. That's an annualized rate. Well, it's, as you know, it's the effective rate. You know, there's a range for the target. Effective rate is now about 3.8, 3.9%. And based upon the rate of inflation, based upon how the economy is doing, I would say that it's not far off. It probably would be a little bit higher, but in a way, I'm spitballing because, again, so we've got to leave it to the market. We're pretending that we know what the market would want, but I will answer the question. I would say that I think that, if anything, it should be a little bit higher if it really is going to reflect what would be market preferences, which are unable to express themselves given the interference of the Federal Reserve in the credit markets.
All right. So maybe I'm just totally off on this, but when the government is borrowing money, the bonds that it's trying to issue so that it can borrow money, isn't the interest rate that it offers somewhat or aren't they targeting, when they're doing those bond sales, about what the Fed is setting the interest rate at? So in other words, if the Fed is set like the Fed funds rate or whatever at 4.9%, and now I'm the government and I'm looking to borrow money and sell a bond for the next 30 years, aren't I setting that interest rate in line with what the Fed funds rate is, because the Fed has kind of established what the interest rate should be? Or is that not the way it's done?
Okay. I would say it's
isn't it
not
kind of
the
a
way it's
baseline?
done. I would say it's not the way it's done. And let me explain, maybe by beginning my story with the lockdowns of 2020, 2021, which was the most egregious example. Clearly, the federal government works on its own dynamic. And of course, Fed chairmen have often said that, well, look, you can't ask me about fiscal policy. I don't control fiscal policy. So what happened in 2020, 2021? The U.S. government shut down half the economy, kept like 1/3 of the people working, and so no revenue was coming in. I mean, I'm exaggerating. It was running trillions of dollars worth of deficits. So that had nothing to do with the Federal Reserve. It had, in order to pay its bills, it had to issue bonds in order to make up the difference between revenue and expenditures. It was sending everybody checks, it was subsidizing. Right. But okay, so my point is that it could not set the interest rate, but what actually did happen, what would have happened had, and now the Federal Reserve does become a part of the story. What would have happened when the federal government in 2020, 2021 was releasing $2 and $3 trillion worth of bonds on the market, is that the Federal Reserve stepped in and bought those bonds. So that's what it has as a stopgap.
And I've seen, and don't they have two other measures by which they can basically juice the demand for government debt? I guess they have one is that they can just actively buy the bonds and basically fund the debt.
They is the Federal Reserve.
Yes.
That's right. That's of course, that's the role the Federal Reserve plays. But the Federal Reserve was not proactive, it was reactive. I'm sure there was some discussion in high places. The federal government would not have been able to lock the economy down had they not had the Federal Reserve to come to the rescue. Because if it was trying to sell trillions of dollars worth of bonds, by the way, $750 billion worth of our debt is held by the Chinese. More than $1 trillion is held by the Japanese. About close to $1 trillion is held by investors in the government in England, in Britain. And so the U.S. government issues bonds to the world. Maybe in a way I started with a wrong example. What I'm really saying is that the budget is out of control, it's running $1 to $2 trillion deficits every year, and in order to pay its bills, the U.S. government must issue bonds. And now, it cannot. It puts it out at auction. It asks the major dealers to bid on those bonds. It's an auction, and
right,
so it has no control.
If the Fed can step in though, and buy up the debt to increase demand for the debt and keep the rate low, don't you end up at the same place as the Fed is basically controlling the interest rate on government debt?
Well, the answer is yes and no, only because what happened in the year 2000, 2001 is that the Federal Reserve bought trillions of dollars worth of debt. If you look at a readily available chart, you see holdings by the Federal Reserve of Treasuries, and then suddenly spiking to the skies. 2020, 2021. It stepped in and bought those bonds, and you're correct. It kept the interest rate low, relatively low, because it stepped in. The cavalry took over. The U.S. government did not have to beg the Japanese or the American investor or the British or the Chinese to buy up that debt. That's true. However, what also happened is now, of course, my question for you: where do you think the Federal Reserve got the money to buy up all that debt, trillions of dollars worth of debt? It got the money from its own quote unquote printing press. It created the money. It has the power, the unique power to create money. Now, what do you think happened 12 months later?
Inflation.
Price inflation started to surge.
Now,
And we see that in a surge in the conventional money supply, M2. So why am I telling that story? The lockdowns caused the government to be broke. It needed to borrow trillions. It borrowed those trillions from the Federal Reserve. The Federal Reserve flooded the economy with money because all of those bonds came from created printed money. That money surged into the economy, and 12 months later or so, there's always a lag with respect to the money supply, sparking inflation. Price inflation started to surge, and our government, Powell and the others, were very embarrassed. Everybody, of course, blamed the greedy corporations. But the one thing we did know is that that Powell knew, and that even the people around Biden knew, maybe Biden knew nothing, or that Trump knew, is that we really don't want a recurrence of this. And I think Powell's not stupid. Powell understood, of course, that the massive purchases by the Fed of those bonds are what brought that price inflation that was scaring the hell out of the markets. Therefore, my only point is that there is at least some sophistication that started with Paul Volcker of the Fed, Greenspan of the Fed, Bernanke of the Fed, Powell of the Fed, that you can't keep monetizing the debt, that's the expression, endlessly, because you're going to run into price inflation that the markets are going to get extremely upset about, that the consumer is going to get, that the president of the United States will get upset about. So I'm going back to your question. Well, can't the Federal Reserve just do it? Well, there are constraints on that I'm trying to go into, and indeed, in the case of the year 2000, 2001, the Federal Reserve was essentially reactive. Nobody asked Powell of the Federal Reserve to buy up that debt. Nobody asked him in advance about the lockdowns, about the fact that we're going to shut 2/3 of the economy down, and that therefore we've got to flood the economy with money so that people don't starve. We've got these trillions of dollars worth of bonds out there, and you better damn well buy them, or the interest rate is going to go sky high. So even then, Powell was reacting. But now that we've gone through the shock of that price inflation, there is clearly some wariness about continuing to finance the debt through the printing of money. Now, I might want to cut to the chase and say that down the road, as the debt keeps rising, $1 trillion, $2 trillion, there's going to be a point at which the Federal Reserve will have to step in massively. I don't know if you know the crazy people, the modern monetary theorists. I call it modern monetary tyranny. I don't know if you know Krugman and others have pointed out to people like me, the federal government will never have to default on its bonds. It can always print the money in order to pay for its debt. And indeed, that is what's going to happen as the debt outstanding keeps rising. It will happen sooner or later. Maybe it won't happen for another 15 to 20 years. A massive need to purchase the federal deficit, the federal bonds, because the debt is out of control, and that the holders of our bonds are losing confidence. However, that will mean another price inflation. It will mean an effective sort of practical default, because it will mean, again, that the dollar will be worth less because of price inflation. I'm going, I guess, way out, but I'm trying to answer your point by saying that the situation is such that at this point in history, getting back, I guess, to where we are now, there is a certain reluctance on the part of those at the Treasury, who respond to the fiscal needs of the federal government and those at the Federal Reserve to monetize enormous amounts of the debt because they know it's going to bring another surge of price inflation. So therefore, the federal government pretty much has to be out there the way any corporation is. You're floating a bond issue, it's underwritten by professionals. You're floating a bond issue, and you have something like 12 or 13 treasury dealers who initially bid on it at auction, and then they try to unload it on others. I mean, I will tell you something funny that there are, I think, I forget who was the one who said it. You know what the Chinese could do to us right now if they want to screw us over? They do own $750 billion worth of our debt. And if they dumped all of that debt in a matter of, let's say, a couple of weeks on the credit markets, that could be enough to screw us over for quite a while. Because that could drive them. Who the hell's going to buy up, let's say, $750 billion worth of debt? And they might get a few other countries who own some of our debt in order to add to the pain. But in other words, the point I'm belaboring then is that the fiscal needs, the mandatory spending, Medicaid and Medicare, the military spending, the $1.5 trillion that Trump wants, all of that is what's determining the need for the U.S. government to borrow, and its borrowing at this point is at the mercy of the market. Now, of course, obviously, it's backed by the full faith and credit of the U.S. of the federal government, and so of the Treasury. So, therefore, it has a certain amount, commands a certain amount of security potentially. However, it depends then on how the dealers feel and what they want to spend on buying that debt. If they want to pay a low price for it, it's got a certain par price, so they pay a low price, and that means the interest rate goes up as a result. So therefore, the Treasury has only limited power over the interest that it has to pay on its debt. Maybe I could work in one of the classic jokes that if we wage war against the Chinese, we'll have to borrow in order to finance that war from the Chinese.
All right. So just last question on this topic, and this might be too loony / conspiratorial for you. But aside from the Fed buying basically our own debt to, artificially boost demand and keep the interest rate down.
Yeah.
Well, I'll ask, I'll just ask it to you. Are there any other tools that they can use to try and manipulate it downward? In other words, if they go to auction and the actual interest in our debt goes up, let's say people are starting to bid up the bonds like 8, 9, 10%, and Trump goes, man, I can't possibly be spending all the money that we can't afford. That's crazy. I need a better deal. Do they have any other tricks up their sleeve other than the Fed just buying the bonds to push the rate down?
Let's say I don't think so. I guess if I were reaching, Trump could plead with Chinese investors and the Chinese central bank, with the Brits, with the Japanese, with the Saudis, with other foreigners to buy more of our debt. But I don't think that'll work too well. And by the way, I want again also to point out a subtle problem that we haven't made clear, which is that if the Federal Reserve keeps monetizing the debt in order to hopefully keep the interest rate from going too high, then that will cause price inflation, and the price inflation in and of itself will drive up the interest rate, because the buyers of debt will want to get if they expect inflation to run 12%, they're going to be very reluctant to buy our bonds at 8%, because that's an inflation adjusted, that's a loss of 4 percentage points. And so that kind of problem, by the way, is what happened in the much worse inflation of the 1970s. the inflation took off, and the interest rates that bonds could be sold at took off because the bond market suddenly realized that it doesn't seem as though this inflation is going to stop, and so why the hell should we buy those bonds at 5% when we expect inflation to be over 10%? So I'm only trying to point out the various problems that are faced, and the frustrations that Powell must go through at the Federal Reserve because the fiscal policy, the spending of the federal government is not something it controls, and the spending, of course, exceeds the revenues. Now, of course, I guess the part that you left out of your question is why can't the U.S. government just raise taxes on the rich, which of course is what the left wants, and the problem is that if we crunch the numbers, and even if we include, as you remember, Bernie Sanders used to talk about those millionaires and billionaires, and then once Bernie became a millionaire, he only talked about the billionaires. But even if we take every damn dollar the billionaires and millionaires have, it won't last very long. It won't carry us for very long. We have to raise taxes on the middle class. The U.S. government does. In fact, as you perhaps know, taxes on the middle class in countries, in the welfare states, countries like Sweden and countries like Denmark, are higher than in the U.S. The politicians do not want; they only want to go after the billionaires now. But there's not enough money there. There was a calculation that if we took every last dollar from every billionaire in the country, it would be enough. I guess it's impressive. It would be worth 12 months. In other words, it would be enough to have a balanced budget for 12 months, and then the billionaires wouldn't have a dime left to offer in the following 12 months. So therefore, they have to raise taxes across the board. So therefore, again, you can't raise taxes. You have spending on Medicare, Medicaid, and Social Security rising inexorably. That's mandatory spending. You have a military budget that's going nuts, and so you have continual massive spending, and you can't raise taxes. The revenue is too short, so you have to borrow, and all those dynamics are in a way beyond anybody's control. The only thing actually that you could say Trump could control, at least more directly, is, of course, military spending. And then, of course, there would be ways to begin to cut back on those
Which
entitlements.
Clearly he's not doing.
With less fraud. Excuse me?
Which clearly he's not looking to reduce government military spending.
Well, not the military spending, and even I guess there is some kind of treasure hunt going on for all that waste, fraud, and abuse that took blacks in Minnesota to check out if it's happening elsewhere. You know, what was that great joke that this thing was supposedly called the Learning Center, financed by the federal government?
Leering Center.
And they left out the R. In other words, they were so illiterate that it was actually officially listed as the Leaning Center, even though they meant they were those Somalis. I hate to single out the Somalis because the Somalis do it less than ordinary Americans do. But it was just hilarious that the governor of Minnesota, Mr. What's-his-face, that nobody even noticed that this thing was called the Leaning Center.
Yeah. All right. So I promise last question on this topic, because I do have a bunch of other stuff to get to, and we haven't even gotten into the Gene Epstein side of the episode.
Yeah.
I mostly asked this because I think it was the SBF or SFB bank when it failed down in California.
Yeah.
So from what I understand, they changed the policy of the way that banks are declaring their bond assets, and that there were a lot of years where there was really low interest rates on bonds.
This is a private bank you're talking about? Yeah.
No, I think at all banks that basically the bonds on their balance sheets, I guess it used to have to be marked to market. And so if the interest rate went up, you would have to devalue the bonds that you were holding. And so I believe that they changed the policy that you can just basically keep them to expiration. So you don't have to, it's just a simple time value money thing. If I'm owning a bond at a 2% coupon, and then the public interest rate goes up to 4%,
then
usually I
your
would
bond is
have
worth
to,
less.
my
Yeah,
bond
yeah,
is worth less because,
yeah,
and the longer time period I'm holding the bond for,
yeah,
the more I would have to mark it down.
yeah,
So from what I understand, they changed the policy that they
yeah,
could basically hold those to expiration and never have to mark them down. And what I saw there was basically kind of a collusion between government and the banks to incentivize the banks to hold government debt and
yeah,
say, hey, if you're taking because it was common wisdom. Listen, when
yeah,
bonds were at 2%, don't buy a 30-year bond. These rates are going to go up eventually. And then you got
yeah,
people, well, I need safe yield somewhere, so I'll buy it for 30. And then the government basically bails you out by going, all right, yeah, you did lose money in that bond, but at least we'll let you keep it to expiration. You continue to borrow funds against it and keep it as prime capital. So the
mhm,
reason I just bring this up is, I don't know. In my head, there's a bit of a
yeah.
conspiracy that the Fed also can work with the banks and basically work out other ways for capital to basically be used to buy government debt and then be bailed out at later periods.
Okay, I'm embarrassed to say that I'm only vaguely familiar with this story, but I'll accept the way you recount it on its
You might not
face.
want to.
But
It might be totally wrong.
well, well, I'm trying to remember. There was certainly incentives in the going up to the housing bust of the '90s and into the early aughts. In incentives that were being offered to buy up mortgage debt because every presidential administration from Clinton to Bush wanted the home ownership rate to rise, and so they wanted these mortgages that those who took out the mortgages were probably not going to be able to pay on, but they wanted the mortgages to be bought up by the banks, and so they offered incentives. So I can imagine that could be happening. I can't regard it when you're talking about $1.5 trillion every year rising to 2 trillion of debt that you have to move every year, adding to the accumulation of debt every year. Hard to imagine that that even fully granting that this might mean it helps to move that debt. Hard to imagine that it's going to make a significant difference in terms of the outlook for the debt and for the deficits. Certainly, I read the Congressional Budget Office reports. I do mainly because they're nonpartisan. They tend to be Keynesian and traditionalist in their approach, but they keep sounding the alarm about the accumulation of debt and the rising deficits. I would imagine they would know something
So
about that other factor that you mentioned. I can't imagine that it's going to make a huge amount of difference, even though I can imagine it's what they're doing.
So I have to ask, it might not be Donald Trump's problem, but
Yeah,
it sounds to me
yeah,
like they don't have endless tools to basically rig the interest rate on government debt down. I
no.
can't imagine it's going
Well,
to stay at the 4.5% forever. That's not
yeah,
historically even what we financed our debt at. And
mhm,
as we're carrying the most amount of debt that we ever had, as
yeah,
the interest rate goes up, that becomes, monumentally more of a problem. With the more debt you're carrying, the higher the interest rate is
yeah.
to continue to fund it. You're going to have to see interest rates going up at some point, and then you're going to have to see some sort of reduction in spending. It seems like an inconceivable loop for government to just kind of continue to increase spending in an environment where you're going to have to service debt at higher rates.
Yes. And see, I was when you were asking me earlier about um, the interest rate and where it would be, I was mainly thinking about the interest rate for loanable funds in the private markets. Even though it seemed as though maybe I left the impression I was talking about the Treasury debt. Uh, you're right about a couple of things. First of all, um, it does uh, it does surprise me that that 20, I don't know offhand, but what the 20-year bond is going for, less than 5%. It does surprise me that buyers are still willing to accept 4 to 5% on long-term bonds, given the trajectory of the U.S. deficits and debt. And even though, again, you and I want to acknowledge what Krugman and the MMT people say. And I mean, we could go into what they say. It's amazing, their claims that the debt is nothing to worry about. But getting back to your point, what's the likely scenario when I was about to say when the shit hits the fan, but when the chickens come home to roost, I guess would be the sort of thing that your viewers would prefer me to say. What would happen once you sort of hit the wall? But what kind of wall will you hit? This could be 10 to 15 or even 20 years away, this problem. And I think that the first thing that will happen, if it becomes harder and harder to sell the debt at some kind of interest rate that the Treasury can absorb, that just the servicing of the debt, by the way, what is it? It's now nearing $1 trillion. Just the interest that government has to pay on its debt. And so once it rises even further, it's going to begin to worry people. Then will the markets, including the Chinese, the Japanese, the Brits, again, 1/3 of our debt is owned by foreigners, owned abroad. So when there begins to be, kick in some kind of concern about the U.S. Debt, then it is true to say that nobody is going to think that the U.S. will default on the debt. What they will think, because there are reasonably sophisticated people out there, is that it's going to start monetizing the debt. And then if it does monetize the debt, that's going to cause price inflation. And if price inflation really does take off, it will mean that the dollar will be worth less against other foreign currencies. And if the dollar is worth less, then foreigners who hold our stocks and our bonds will find they're incurring losses, not from the stocks themselves, but from the fact that if they trade in euros, or if they trade in British pounds or yen, then they will find that the dollars that they have invested in our stock market are worth less against their currency. So they're going to start incurring losses, and there could be a Dow dollar death spiral. They could start dumping our stocks, not because the stocks are doing bad, but because the dollar is suffering. Now that's possible, but even setting that aside, getting back to the first scenario, the foreigners are going to know that, and of course the domestic holders are going to know that the debt will still be paid on. They'll still get dollars for it. But if those dollars come from the Federal Reserve, from printing money, the inflation will take off. And so if the inflation takes off, then that will be a partial default. It will mean that the dollars you get for those bonds are worth less and less, and that will put huge pressure on. I'm only trying to answer your question at some length by pointing out and fully acknowledging those loonies out there who think that the gotcha gang, who think that the concern about the debt on the part of some of us, even the Congressional Budget Office, which isn't even libertarian or even that free market, is foolish, because of course the government will never default. It can always print the money. But I'm trying to go into the problems might arise if it prints the money. And let's just go back to the money printing that would inevitably cause price inflation. If price inflation is caused, then the next bond issuance will have to factor in that price inflation. If there's an expectation that inflation is running 12%, then bond buyers are going to insist on bond interest rates being 14%. So the pressure will be put on. And then now let's get back to what Rob Bernstein just said 15 minutes ago. You said, won't they have to cut back on spending? Yeah, I think that what they will initially do, since they seem to be doing very little with entitlements, is they're going to start cutting back on Social Security, Medicare, and Medicaid. They're going to start shafting people of limited means who are foolish enough to depend on Social Security, Medicare, and Medicaid. Of course, you always go back. You always take it out on the weak when you have to cut back. So that's the first big thing that they will do. I don't know if they'll really cut back on military spending, but there's no. I mean, Medicare. By the way, Medicare and Social Security alone add up to the current budget $2.5 trillion alone, and so it is true. Getting back, by the way, to something you and Dave were arguing. I'm a regular listener of Run Your Mouth and a part of the problem. Talking about those who are challenging you and Dave when you said the Federal Reserve finances our military. Well, it is true that even if Trump, there's the $1 trillion military budget, and of course that's not even counting Homeland Security. But then if Trump wants to move it to $1.5 trillion, that's obviously stunningly high. However, it is true that it's not as high as entitlement spending. Medicare and Social Security alone are $2.5 trillion. However, of course, given that commitment to mandatory spending, if the Federal Reserve weren't there to step in as needed, we couldn't have that kind of complacency. See, I guess the other interesting aspect of your question, Rob, is what do our politicians know? You know, I think that Rand Paul understands everything that I've set forth, because after all, his father Ron Paul taught him. But I think the average congressman and the average senator is pretty clueless, although about what is really going on. I mean, they probably really believe that the price inflation was due to corporate greed. And of course, our usual joke in response. Well, I had two responses to that frequent accusation. Number one, how did corporations suddenly get more greedy than ever? Well, isn't greed pretty much of a constant? And then aside from that, pointing out that inflation was actually pretty tame going up to 2019. Actually, was in the inflation rate was decelerating, and therefore it looked as though corporate greed was beginning to diminish, and then suddenly corporate greed has a big spike. But I went into that part of it. But I'm only saying that I believe that Powell and the Treasury and the Congressional Budget Office pretty much know what is going on, and I think that sophisticated investors know. But apart from that, what they will see, even if they don't know anything, investors and Chinese and others who buy our bonds, let's say there's not a whole lot that they do know. So the bonds are suddenly difficult to sell, or the debt is getting hugely high. The bonds are out there. They need to borrow $3 trillion, and then they start monetizing it through the Federal Reserve. Suddenly, the price inflation a few months later starts to appear. So everybody notices that. So in other words, what I'm trying to get at is, even if you're pretty ignorant, you'll see the price inflation, just as, of course, we did see the price inflation in 2021, 2022, 2023, although half the media, the legacy media didn't know what the hell it costed. Half the politicians didn't know, but they saw it. And of course, they recognized this has got to be tamed. We've got to do something about it. And by the way, I do commend Powell on and the Federal Open Market Committee on the aggressiveness with which they hiked. They used the one lever they had. They tightened credit. They hiked the federal funds rate very, very quickly. And I actually thought that violent move up, taking the punch bowl away from the party, as the conventional language has it, was going to bring a recession. But amazingly, the economy muddled through, even though he raised it to above very quickly from 0 to 1% up to 5.5%. Getting back to your story, the point is that it's a little bit speculative as to what's going to happen and when once the debt gets totally out of control. Once it rises above 150% of GDP, once the borrowing of the U.S. government begins to become excessive, when that will happen, there will be no default. The Federal Reserve will step in. The interest rate will then go sky high. That will create additional problems. And then, if you ask me, won't they have to cut back? Yeah, they'll start cutting back on entitlements for people of limited means. So I guess that's my best answer to the story. Right, so but yeah.
Before we take a look at, because there are some other new mechanisms Donald Trump is implementing to flood the system with more cash, which you and I understand it's a devil's deal. If someone offers you free money or offers the economy free money, it seems like a good idea, but it usually drives up prices. But before we get into that, we're a full hour in. Why don't we take an opportunity for some plugs, and why don't you let us know what's coming up on the Soho Forum?
My God, Rob, I've got to open my window. So, okay. When will this be aired, Rob? What date?
We're live. We're literally live right now. The internet's watching. We got 200 plus people watching right now, and a couple thousand people will see this by tomorrow.
Okay. Yeah. All right. Then on January 27th, Tuesday, January 27th, at the Soho Forum at 18 Bleecker Street in downtown Manhattan, we will have a debate on artificial intelligence.
That's a good one. That's topical.
Yeah, a very brilliant guy named Perry Metzger will oppose another brilliant guy, and Perry Metzger will defend the resolution that reads, artificial intelligence will bring huge net benefits to most people. In other words,
if I'm around, I got to attend this one. This is a good one.
What?
I said, if I'm around, I got to attend this one. This one's right up my alley.
Well, that's great. You can line up to ask questions. And the guy who will oppose him, I wanted to get that guy with that, was it Sukowski, that crazy Hebrew? I don't know if you know what I mean. The guy who keeps saying, and he's been written up in the Times, he keeps saying that artificial intelligence is going to murder us all. It's going to turn on us and kill us all. So we won't have the debt or the deficit to worry about, Rob.
There you go. Might as well party. Might as well party and spend to the end.
Yeah. But the point is that I'm not. As a matter of fact, he's so prominent that I did ask him if he would come to debate at the Soho Forum, but he turned me down. He didn't want to debate the people. He didn't want to debate Perry Metzger. As a matter of fact, I thought Perry would be the best to oppose him. I mean, the obvious problem with that argument is that we are being anthropomorphic to attribute a will to artificial intelligence. Artificial intelligence is just a powerful tool, but it doesn't have a will. Now, by the same token, obviously, nuclear weapons are going to kill us all. But clearly, nuclear weapons don't have a will. It's just somebody will drop them on us, sure. And of course, it is true that somebody can use artificial intelligence potentially to kill us all, but that requires somebody with a will to actually do it. And then we might be able to fight back through artificial intelligence. The guy who's going to oppose Perry, I know, believes that it's going to impoverish us all. And I guess he thinks that it's going to take everybody's jobs. I don't want to prejudge the debate or express much of an opinion. I usually go silent once I announce a debate because I'm supposed to be a moderator, not an advocate. I don't want to be an immoderate moderator. But it will be a crackling debate. And as a matter of fact, I will bring. You did great work as a warm-up act, Rob, and Dave, of course, became such a dangerous warm-up act that the pandemonium his jokes would create usually sort of like warped the whole entire evening. I don't know if you know that story about a debater.
I really enjoyed watching Dave when he was doing the warm-up stuff because I was always shocked by how many jokes he had on that night's topic, which is not the way
he told a joke, and then one of the debaters got up and said,
"I heard this is the socialism, right?
What?
Wasn't that night the socialism debate that you did?"
Well, the socialism debate was bad enough, but he told somebody in the audience, the punchline was, he told this socialist heckler in the audience, "Please give me a list of all the things that you don't want me to say that might offend you, and then take that list and stick it up your ass." And
that's fair. That's a good way to use the list.
Well, that's insulting our audience. But the worst one was he told a joke which involved black people. Actually, the other joke was with black people, and one of the debaters got up and said, If I knew that joke was going to be told at this debate, I never would have shown up." That's what the debater said.
Real censorship lefty.
So I'm sitting there in a state of fear that the guy is going to walk off the stage. And if you want to know the complete follow-up, is that on Dave's podcast, he talked about the guy, and he said, and he didn't have the courage to walk off the stage. He said he was going. He said he wanted to, but he didn't do it. And then I want to say, Dave.
You're like, Dave, I'm trying to run an event here.
But that's when I want to say, Dave, you are fired. you don't you understand? I'm an impresario. In other words, you really wanted the whole show to collapse. You wanted that guy to walk off the stage.
He was talking shit on the podcast.
Yeah,
all right,
so let's acknowledge. But I will have a young woman who told some excellent smutty jokes at a recent event I attended, and so I invited her.
Nice. What's her name?
I haven't had a warm-up act in a long time. I'm going to invite her as warm-up act for this coming debate. Again, on January 27th, go into the sohoforum.org for tickets. They're selling out fast. It's $24 for tickets, and I think it's an extra $10 to come to our after party, which is held.
The after party's good hang. They put out a good spread. Who's the female comic's name? Do you know?
I'm forgetting her name.
That happens to me.
She's probably obscure, but she told a joke having to do with onanism. I'm sure that many of your listeners don't know what that word means, so I'm being all right. And then I thought it was pretty funny.
All right. Okay, let's cover two more, and then you can decide if we should take a bathroom break and continue, or if you want to do a part two on another day.
I don't have to pee.
I know. I have an older prostate than you do, Gene.
You've got a very weak bladder, Rob. So just pee in your pants. But
yeah, I get the Gene permission to do so. All right. So there's two other things that Donald Trump, or I mean, I guess not both Donald Trump, but we'll start with this one. He's encouraging, I guess, Fannie Mae to go out and buy more of the mortgage-backed bonds to try and push down the interest rate on homes. Curious if you saw that, if you got more details on the specifics, and how you think that's going to play out.
Well, Well, as a matter of fact, you're talking about, God Almighty, why am I forgetting? Yield management. What was it called? There was an attempt, obviously, to buy up long-term bonds to keep the interest rate down, and there was really it was really a matter of debate about how effective that was. And of course, Fannie Mae and Freddie Mac and others were buying up massive amounts of mortgage debt. And the harm that that was doing, of course, was that this debt was being issued to people who basically had no job, no credit rating, and it was almost inevitable that they were going to default on that debt. So what happened, for example, was that Countrywide, run by the infamous Angelo Mozilo, was doing massive amounts of mortgages, and he knew nothing about mortgages. He just issued the mortgages and then sold them to Fannie and Freddie. And so he was just basically running some kind of cash machine for himself. And so, of course, it's dangerous when you have government buying up mortgages, then rather than what used to be the case, that you had to face that starchy bastard at the bank in order to get the mortgage, who had to evaluate your character and your credit rating, and he might deny you the mortgage because you weren't a good credit risk.
No, I gotta.
But obviously,
yeah,
he's not going to give a damn. He's replaced by the crapshooter. Well, of course, we'll give you the mortgage because he'll take some money off the top and then sell it to Fannie Mae or Freddie Mac. So, of course, that's the principal danger, not so much the effect on the interest rate, but the fact that you take all risk out of the market and then you start bringing in people who would not pass muster in a normal market situation where your character and credit are evaluated, and they tell you, well, you'll just have to increase your income, or you'll have to, put a larger down payment down or something to that effect in order for us to trust the mortgage that we'll give you. Because while, of course, it's a collateralized loan, we can always take your house from you if you default. That's a huge hassle that we're reluctant to do. So therefore, that's why we had a healthy mortgage market by and large prior to the 1990s, when the government went crazy about buying up mortgages, and now Trump is bringing that back. So that's only going to cause harm.
So I got to ask, it sounds to me like the current number is probably not high enough to, it's $200 billion, which sounds like a ton of money. But I don't know if that, 200 billion is the number. I think I saw that he was, I guess, either handing to Fannie Mae or encouraging Fannie Mae to go buy to go buy up the bonds. But now I see two problems here. I don't know if 200 billion is enough to have the impact. I just see more of a problem in the conceptual policy, which is one, if you're making more money available for people to go ahead and purchase houses, you're driving down the interest rate, you're going to drive up the prices of current homes. So if you're a first-time buyer, you're going to be saddled with more debt. But also, if the money's not even coming from the banks, which I get is kind of fictional because it's fractional reserve banking, but if the government's just introducing more money into the system because I guess they're printing it and they're giving it to Fannie Mae, and so they're giving the money.
See, again, you talk about the government. The fact is that, again, that's why I try to explain to you, Rob, and you should learn this lesson, is that we've got somewhat complicated dynamics. We've got the U.S. Treasury that does not create money, and we've got the U.S. Treasury that has to cover all the spending on the part of the federal government, president and Congress that refuse to raise taxes. And so the Treasury has got to make up the difference by selling bonds. And so that's an independent dynamic that has to do with the fact that revenues are way below spending, and the Treasury has to make up the difference. That in a way is a dynamic that's based upon the politicians' refusal to raise taxes or to cut spending. It's the fiscal story, and Powell has a right to say that he has no control over the fiscal decisions of the federal government. The Federal Reserve has got to at times be called upon to buy bonds when the Treasury feels that it should. Now, getting to Fannie and Freddie, there is some argument made that in the real crazy housing boom, Fannie and Freddie didn't have the power to create money themselves, but that they were getting it from the Federal Reserve. They were in some subtle way. I'd have to remember what the dynamic was. That in effect they were able to act like a Federal Reserve, even though they didn't specifically have the power to print money. So
if you just go looser, if you just go looser with it though, and say a government policy is making more credit available to the market than would otherwise exist in the market, isn't that going to both drive up
making more credit available than we're okay?
So in other words, if you just left the banks to themselves, the banks are going to lend out mortgages in line with how much money they have sitting around and the credit risk of the people that they want to lend the money to.
Yeah. Well,
and if there wasn't fractional reserve banking, it would be more limited by what actual labor had been performed and how much money people had actually earned and were depositing into banks. Yeah. The more credit you make available, the more money they have to then put in, which is going to be, I mean, it's inflationary in two directions. It's directionally inflationary in that if everyone's going out to buy an asset like a home, it's going to drive up the home value. But then it's also inflationary because people think they're sitting on an asset that's worth more than it otherwise would be. And so they might even take out money against it or just otherwise increase their spending because they think, oh, look, I'm living in a $2 million house here. I've got a lot of money to spend because I don't have to worry about my retirement. My retirement is I'm going to sell my house. I'm good for retirement. Let's not save in the same way. So I just think if the government's creating a policy essentially to expand home ownership, and that policy includes not, as you and I explored earlier on our zero hedge, basically changing the zoning laws to increase housing availability, and you're not looking at, the supply side of it of making more homes available. You're just making more money available for people to go purchase the current stock, or I guess to incentivize home builders to go build more. It sounds both like you're going to drive up you're going to drive up the price of houses, saddle people who are trying to purchase these houses with more debt, and two, it also sounds like an inflationary move.
Yeah. Okay. All that's correct. I guess I was perhaps looking at it under too much of a microscope by trying to ask, where is that $200 billion going to come from? Fannie and Freddie are not the Federal Reserve, and they have to.
But I guess they aren't they backed by the government? So they're kind of like aren't they somewhat backed by the government?
Yeah. Okay. I'd have to get it there. I haven't tracked them in a while. I think their situation has changed. In other words, if they're backed by the government. But again, you have to understand that the word backing is a bit loaded. They've got to get $200 billion from the government. In other words, backed by the government. Indeed, what happened, if you may recall, is that they both Fannie and Freddie went bust, and they declared bankruptcy. They went into receivership, so they were backed by the government in that they defaulted on a lot, and the federal government took them over, and it cost a lot of money for the federal government to do that, to take them over. So they were backed by the government ultimately. I mean, and that was the whole point about Fannie and Freddie bonds. That the idea was, if you may recall, that they now that, forgive me, now I'm remembering, Fannie and Freddie have the power to issue bonds.
Right, which essentially they're going to get a lower interest rate because it's like the government defaulting.
Well, but their bonds used to trade at just the interest rate that they had to pay was just a little bit higher than the Treasury rate, because the feeling was that their bonds are really, even though nobody ever said so, that their bonds were really going to be backed by the full faith and credit of the federal government, and that basically is what happened. So probably, I haven't thought about Fannie and Freddie in a long time, so sorry for fumbling the ball on this. It does look as though, I guess, Fannie and Freddie are going to go back to the market to issue bonds, but those bonds will come from the credit markets. I don't know. By the way, just to make things more complicated, I hate to feel that I've just made things more complicated for the listeners, but the Federal Reserve actually does buy some of Fannie and Freddie's debt, does buy mortgages. So therefore, it might be selling some of those bonds to the Federal Reserve. But in any case, I was focusing on that part of it. Where's the 200 billion going to come from? It'll come, and of course, you're correct in saying that it will have an inflationary effect. I'm trying. Had I known, I don't know if I can bring a number out of the air about 200 billion against all the homes that are in the country and the real value. We're talking in the trillions. So I don't know if it's a huge share or if it's not a whole lot. But certainly you're right that the direction is clear, that it's going because Trump is not doing anything about the supply side problem with respect to housing. And by the way, it is true that the federal government has limited control over the major reason why there's no building, because of the zoning restrictions imposed by local governments. Although in the New York City, it's other factors as well, the rent control and rent stabilized housing that is off the market, the landmarks commission in New York City that makes it impossible to tear a building down. So that you can't ever replace it with a larger building. And they've landmarked my wife's building. My wife owns a building at 5 Bleecker Street, and she keeps saying, "What a crazy government that would landmark this building." It's not as though she bought the building in order to make money from it as a hotel for Japanese tourists, but she doesn't claim that it's a beautiful building, and yet they've landmarked it. Here's a funny story about landmarking. I mean, they have landmarked so many buildings in New York City. It's a little known problem as to why there's no building. You can't tear these buildings down. And when the Landmarks Commission celebrated their 50th anniversary, my son Jim did a video, and he asked a hypothetical. He said, "What if they were celebrating their 100th anniversary, not their 50th? What if they started landmarking 100 years ago?" He said, probably they'd go on their landmarking spree starting 100 years ago. And then he started listing all the buildings that were torn down, 70 years ago to put up new buildings that they probably would have been landmarked, and those new buildings would never have been put up. And yet we're supposed to think the Landmarks Commission is such a great institution.
We'd have horse and buggies and I said we'd have horse and buggies and those wooden and brick buildings.
Maybe so. Yeah, but what's interesting is that, of course, we libertarians want to say that if a building is really regarded as a beautiful piece of architecture, if it's truly
the genes of the world will buy and preserve it.
Yeah, exactly. Go ahead and buy and preserve it. It will in and of itself command a premium on the market for being beautiful. But you should see the ugly damn buildings that the Landmark Commission is now.
And if some rich asshole wants to take down a beautiful building and if some rich asshole wants to buy a beautiful building and put up his modern thing that you and I will scoff at, firstly, he's a rich asshole, and that's what you get to do. And then we get to scoff at him for being a rich asshole, so everyone wins. Gene,
are all assholes rich? Rob, I take offense at what you just said.
Well, if you take down a beautiful building that people like walking across because it looks beautiful, and you decide to replace it with like a brick, one of those Russian Soviet style, just cement slab things that everyone hates looking at. That's a rich asshole move. Gene, I gotta use the restroom.
That's a rich asshole, Rob. But what I'm trying to tell you is that if a building is regarded as some kind of monument to architecture, some kind of beautiful spot that people love to visit, then it will command a premium in the marketplace, and there will be a market incentive to hold on to it. There will be a market incentive.
And it's also a better way of finding out what actually is within that category. Gene, I got to take a quick restroom break. I got options for you. I'm good on options. I can put the comments on the stage, and you can deal with these animals in the chat for a minute. If you want to plug another Soho Forum, I'll be back within 60 seconds. So you can just sit there.
Okay, the countdown, Rob. You're a fast peer. Okay, start unzipping, Robin.
Okay. How about I'll let you take comments if you can see them. You are live, and these are the people in the chat listening to the show.
Architecture, please.
However, I warn you, there's someone in the chat is Natalie, and I don't believe that's actually the producer on Gas. So, but you can respond. Sometimes they got good points, and sometimes they're highly offensive.
And all the whores on Bleecker Street.
There you go. Like I said, highly offensive. I'll be back 60 seconds, Gene. Enjoy.
Take a pee. But because I'm not these and all the whores on Bleecker, please keep busting Robbie's balls. Okay, that I like. JR Texas, who has a bigger hog? Dave. This is vulgar stuff. Oh, I see. Oh, okay. You're referring to this is all smutty stuff, and so I can't comment on it while Rob is urinating. And so I'm afraid we're going to have some dead air. However, I guess I want to mention again that not just the debate on Tuesday, January 27th at 18 Bleecker Street at the Sheen Center in downtown Manhattan. I only do debates in front of a live audience. During the lockdowns, I had to go off the live audience and do it on Zoom, but I very quickly went back to my live audience once the lockdowns were lifted. I've been doing monthly debates since 2016, and perhaps you'd be interested in our best-selling, but best viewing debate of all time. It's gotten 8.4 million YouTube views. All our debates are preserved on YouTube and podcasts. And the 8.4 million YouTube views was enjoyed by a debate between the eminent Marxist Professor Richard Wolff versus me. That was my debate with Richard Wolff, and I'm happy that it's had that many views and gotten that much attention. Go on to thesohoforum.org into past events, flip to 2019, and you'll find that debate that has gotten 8.4 million views, Rob, my debate with the Marxist Richard Wolff. I guess I want to just mention a couple of things, Rob. You're going to give me the floor a little bit. The main thing to say, I had with one chart. Do you want to show that chart on unemployment insurance claims?
All right, hold on 1 second. That's the wrong view. I will get us there. There you go.
Yeah. No, that's the Fed funds rate. I wanted the other one. The other one.
I got it right here.
Yeah. Okay. So the thing that I value about this chart is that it comes from all 50 states plus Puerto Rico and the Virgin Islands, and it's the reports from all 50 states representing about 98% of private firms, almost a universal count of the weekly unemployment insurance claims. The average weekly unemployment exchange average weekly unemployment claims averaged on a monthly basis. And this goes through December of 2025. The gray bars are recessions. Now notice that every time a recession happens, claims spike. Now, sometimes, of course, they take a little bit of a while to spike. That's true. So this isn't a perfect indication. But what I'm trying to latch on is that this is not just a sample that you can challenge. It's not a number that's troubled in any significant way. It's basically a universal count of claims. And notice that claims have been pretty flat through December of 2025. If a recession were occurring in the fourth quarter, had occurred in the fourth quarter of 2025, I think we'd see those claims beginning to spike based upon the past record of claims. And so if I had to point to just one number that indicate that we are still sort of muddling through very modest economic growth, but the economy is still growing, at least as of our latest data. I would point to claims. But now go to the other chart I wanted to show.
I think that was now this one.
Screwed up again, Rob. Yeah. Okay. So now, actually, the interesting part is that we were talking about the Fed funds rate and talking about the 10-year Treasury bond rate. And what are we looking at? We're looking at the Treasury bond rate minus the Fed funds rate. The Fed funds rate is the overnight rate, the very short-term rate, and the 10-year rate is, of course, got a 10-year duration. And what do we see when we take the Treasury bond rate minus the Fed funds rate with that zero line cut across? Well, we see that usually, as we might expect, the 10-year rate is higher than the Fed funds rate. Usually it's higher. But every once in a while, the Treasury rate minus the Fed funds rate is a negative. Every once in a while, the Fed funds rate is higher than the 10-year Treasury bond rate. And that's when that line goes below zero. It goes below zero, and then it begins to rise back up a little bit above zero. Now notice those gray bars. And you'll see that this interest rate spread is actually the single most reliable indication of an imminent recession. Very few false alarms, false signals. It is true that, however, that if you look at leading up to the 1960 recession, it went down, but it didn't go negative. But then you'll notice in the 60s it was briefly negative and then went way negative, and we had a recession. So it's not a perfect signal in terms of not giving off false alarms, but it's actually, of all the indicators we could possibly choose as a leading indicator of an imminent recession, it's got the fewest false alarms of any indicator. Now cut to the present. We were negative for quite a while, and up to between 2020, 2025. The line is below the zero line. That's monthly. And now we've gone up a little bit above positive, so that therefore at this point, the 10-year rate is a bit higher than the Fed funds rate. And we won't have to, actually, it's interesting that this gets back to the earlier question that Rob was asking me about what would happen if Trump lowered the Fed funds rate. But for the time being, all we need to know is that there's something to really worry about. All we really need to know is that based on the past, more often than not, when the Fed fund, when the interest rate spread, as defined in these terms, goes negative and then climbs back up to being a positive, more often than not, that signals an imminent or pretty imminent recession. So that's a source of great concern. However, I've been wrong so often that I'm not going to predict a recession in the coming year. I'm only going to say that, go out on a limb and say that I will be astonished, slightly surprised if there's no recession in the coming year, but not totally surprised. The economy seems to lead a charmed life.
The Gene Epstein surprise to totally surprised chart.
I'm sorry?
I said the Gene Epstein surprise to totally surprised chart. I would like that, like in the doctor's office when they have like how much pain you're in. We need the facial diagram of Gene Epstein surprisement levels.
I'm not sure that remark was helpful, Rob. But anyway, okay. But what you were just looking at, I don't know where Rob took the chart away. All I'm saying, okay, it doesn't matter. The point is that we are clearly, based upon the past, just a green eye shade systematic look, we're clearly in danger of a recession in the coming year. Without, I mean, I'm not even going to go into the various explanations. There's actually several different theories as to why this indicator has such a good track record. It would take us too far afield. I'm only asking you to believe that whether it's correlation or whether it's cause, there's an uncanny relationship. It seems to be a leading indicator of recession. But I'm going to say that given all of the perils and mess, the fact that we've had one of the slowest, we have had job growth over the past 12 months, I would still maintain that we're still above water. Young people have very low confidence, and I believe that they were really shocked by the inflation that occurred. That if you look at measures of consumer confidence, there are two major ones, and they're pretty low. And then if you parse them according to age, you find that it's basically the people under 35 who have low confidence in the economy, much lower than you would think, given the fact that we've had some modest expansion. And by the way, I found that everybody's home ownership rate is a bit on the low side. The young people under 35, it's no lower than it is for people above 35. So there's no special number associated with people under 35 as to why they have very low confidence. My best theory is that as they were coming, this is the under 35 group. How old are you now, Rob?
37.
Okay, Rob is 2 years too old to be in the under 35 younger group where the confidence is very low. But I believe that even though their incomes have pretty much kept up with price inflation, only barely so. They're not worse off, but they're not that much better off. And I believe that the trauma of the recent recession, and of course, as Rob and Dave keep pointing out, to talk about 2.7% inflation recently. However, obviously, that doesn't mean that there's no inflation. It only means that it adds insult to injury. It means that we've had, over the last 5 years, prices have risen by about 26% over the last 5 years. That's pretty damn shocking. Grocery prices. That hadn't happened since, nothing like that had happened since the 1970s. And so I think that young people are living in a slightly traumatized state right now, even though I think, contrary to what Rob and Dave usually like to say, that everybody's underwater. Actually, I think that if you parse all of the numbers, you'd find that people are a bit above water compared to 2019. However, progress has been very sluggish. A bit above water is not saying much. It's not saying that people are going to hell. That it's not saying that people are truly suffering. It's only saying that they're not looking at a whole lot of economic progress. Take the 5 years from 2014 to 2019, that period of growth just prior to the lockdowns of 2020, and you'll find that progress was much faster, that wages and salaries rose faster than official inflation. So we were just muddling along with again, one of the slowest rates of increase in jobs over the past year on record, setting aside absolute recessions. We might continue to muddle along for the next year, even for the next 2 years. Hard for me to believe that we can keep it going for the next 3 years. Given especially the indicator that I just threw up, which actually indicates that we should expect a recession in the coming year. I'm going to cover my butt and say maybe not in the coming year, maybe not in the second year. It's hard for me to believe, however, that Trump is going to survive a situation in which growth continues for the rest of his term. I think a recession will hit before he leaves office.
On that note, I mean, aren't we just overdue for a recession based off of basic market cycles. And then also 2 years ago when the yield curve inverted, wasn't that like the only time that's ever happened that didn't be followed by?
Rob, go back to the chart.
No, I understand that that's what we're looking at.
Rob,
yes.
What the chart shows is that by and large, again, I'm not going to, by and large, what happens is that the yield curve inverts, and that's measured by the 10-year less the Fed funds rate. But for some strange reason, what usually has to happen is that it inverts and then goes back to positive area. Now, all I'm talking about is correlation, but notice that it does invert. There's no reason it goes negative. That's inversion, 10-year minus Fed funds rate. But then it has to climb back into positive territory, usually before the recession actually hits. Now, there are various theories as to why that's the case. However, do you see the pattern? You
yes.
Notice that usually that red line rises back into positive to above zero, and then the recession hits. So that's the reason why we weren't overdue, even though I will confess that in 2023, when Powell was hiking the interest rate so violently, the Fed funds rate so quickly and violently, I thought there was enough accumulated malinvestment for there to be a recession. I've since been chastened. My crystal ball is always cloudy, but you see then that it's got to go back into positive territory, which it did as of November and December. So it's completed its cycle, it's done its job, and now it says, please bring on the recession. I've done my job. Got to go into positive territory. So I needed to correct your technicality. First go negative, then climb back into positive territory. Then you'll get your economic collapse. And of course, in 2023, I made the same statement that I'm going to make now, which is that I expected it to happen again at some point over the next 3 years. And I don't know if it's going to be a mild recession or the mother of all recessions. I can't be surprised either way. When I was talking to Matt Kibbe, actually prior to 2023, he told me I'm crazy. It's going to be the mother of all recessions. But if we look back on the pattern of recessions, we had a major recession in 74, 75, a major recession in 81, 82, followed by two mild recessions in 1990, 91 and 2001. So it's difficult to explain, even with the benefit of hindsight, why some are mild. And then we had the mother of all recession in 08, 09. So it has a lot to do, by the way, with the subtleties of how the Federal Reserve handles it. Luck may be involved. But again, mild or otherwise, I think it's going to happen. And again, those who truly believe in this pretty reliable signal, which gets it right most of the time as a leading indicator, will say, well, looks as though we're going to have a recession in 2026. They have a right to say so. I can only say that we've had a couple of false signals, as you may have noticed. And the economy, sometimes the rules often change. There's so many imponderables that are different from the way things used to be that it's a little bit hard to say that the past is always prologue. But there are too many risks involved for me to refrain from predicting that there will be a recession at some point over the next 3 years before Trump leaves office. And probably I should end on that note, Rob. I've probably worn out the patience, and you probably have to go to the urinate because you've got that weak bladder.
Exactly. All right, Gene, can I hit you with one more and then we'll save the other stuff for another time? All right, because I did have some other topics, but they're evergreen and things that I wanted to get your libertarian theory on. But I think this is the last one that's kind of on this topic is looking for a little education on quantitative easing.
Was quantitative. I guess at the age, yes, quantitative. Yeah, that's the purchase. Yeah, okay, quantitative easing. Go ahead. Yeah, I forgot the phrase. I'm embarrassed to say.
I guess the first part of this, before we look into the history of quantitative easing, is I've seen chatter that the Fed is essentially just embarked on a new era of quantitative easing, but they're not calling it that. And people are calling it like technical easing. I don't know what's going on with. Yeah, I don't know what's going on here, so I'm curious if you can tell us what's going on that some people are claiming the Fed is back to quantitative easing.
Well, quantitative easing consists of the purchase of bonds with something like a 10-year maturity, give or take. They purchase. If you purchase those bonds, then they become pricier. And again, I want to school people, of course, in the simple math of bonds. Bonds have a face value and a fixed coupon. So if the price of the bond rises, then that means that the payout on the bond falls because it's got a fixed payout. Payout falls, and therefore purchasing bonds should mean that that you keep the 10-year interest rate lower than it would otherwise be. That's the intention of quantitative easing. And in order then, and by the way, I'd have to review the point, but that part of the argument about the chart that I put up about the 10-year versus the Fed funds rate, that the argument has been that because of quantitative easing, it's changed the rules, and that maybe we shouldn't be so concerned about the inverted yield curve. It's all that actually relates to doubts expressed about the reliability of that inverted yield curve that I put up as a chart. However, I think that there's a respectable school of thought that doesn't use the term bond vigilante, but I was dealing with a data person who built an econometric, a multivariate model that explained the 10-year interest rates. And he claimed that there was no evidence that quantitative easing was having anything more than a negligible effect on the long-term interest rate. Because the 10-year also trades in the markets, there could be countervailing forces that will start selling those bonds, that there's more selling, that the dynamic would be, why is it that the Fed is not having an effect on lowering the 10-year interest rate? Because those in the marketplace, including the Chinese, the Japanese, and so on. By the way, the Chinese used to own more than $1 trillion worth of our bonds, and they actually have sold some off. They're down to $750 billion, or they've let a fair number expire. But the only point is that there's a big question mark as to whether quantitative easing has the desired effect. There seems to be little doubt that the Federal Reserve has power over the federal funds rate, the overnight rate, of the overnight interest rate between banks. But the idea that it can have so much power over the 10-year rate where there's so much market turnover and where holders of bonds could start just selling those bonds to the Federal Reserve, and that therefore it's kind of a wash. Are there purchases being offset by sales? And then apart from that, as I mentioned, the econometric explanation for the 10-year rate, according to this source, pointed out that he saw no evidence that the 10-year rate was really responding to anything the Fed was doing with respect to this quantitative easing. So again, there's just we're dealing with smart people, but we're also dealing with people who make huge mistakes.
I say this, I need an education on this, but with quantitative easing, I thought they were directly buying up assets.
They buy, well, but yes, yeah, no, they buy quantitative easing consists of assets. It consists mainly of buying 10-year bonds.
But from like public companies?
No. Oh no. The Federal Reserve will only buy treasuries or mortgage debt. It will not buy. Well, I guess mortgage debt from Fannie and Freddie. I guess mortgage debt is private. But no, it will not. It will not buy corporate bonds.
What was the storyline then? And maybe I just have this totally wrong, or I'm connecting dots that didn't exist. But I thought that they were saying at one point companies were taking. I thought it was Fed money from quantitative easing and then basically just buying back their own stock and juicing their stock.
I can only tell you that if you look at the holdings of the Federal Reserve. I mean, we need an audit of the Federal Reserve, but there are some things we know about it. We do have a list of their holdings. They don't hold any private sector corporates. And if they don't hold any, that means that they never bought any. So
essentially, quantitative easing is just so quantitative easing. It's basically just, it's just the normal Fed function of if you want more money in the economy, you're buying the bonds back from the banks.
Well, again, the major aim of quantitative easing has been to keep the 10-year, not only to control the short-term rate and keep that low, but to have some influence on the long-term rate. If you buy the 10-year bonds, you're going to drive down the 10-year rate. So you want to keep that rate low as well. That's the objective of quantitative easing, to have some control, to come to control over the 10-year rate and keep it lower than it otherwise would be.
And who are they? Are they buying the bonds back from the banks? Or are they buying them from the Treasury? Who are they buying them from?
They mainly deal with a bunch of dealers in treasuries. There's something like about 15 of them who they hold auctions. They buy, they sell, and the auctions. You don't get invited to that auction, Rob. Neither do I. And I guess the auctions are done online. I suppose they probably used.
They don't have a good cattle rancher out there.
Excuse me, I'm sorry.
They don't have one of those cattle rancher characters out there.
Yeah,
going for 1 trillion and 2%, 2 trillion and 2%.
And so the Federal Reserve basically. By the way, interestingly, it doesn't. When the Federal Reserve bought those trillions of dollars worth of debt that was issued in 2020 and 2021 by the Treasury, the mechanism really was the bonds were initially bought. The Treasury deals with the primary dealers, something like 15 of them, and of course those are real pros. They buy it up, and then of course they sell it in the secondary market. They lay it off to the Chinese. The Chinese and the Japanese are not invited to the auction, but the primary dealers are. So the Treasury, I know, deals with the primary dealers. And then what happened then in 2020, 2021 is that the primary dealers then sold that debt to the Federal Reserve. So I know that the primary dealers, of whom I think there are 15 or 20, are the ones who will sell those bonds.
Do they get to jockey for who gets do they have to jockey for who gets the Federal Reserve account? Because that's got to be the sale of the century when you're the sales guy.
I never, so much of the scuttlebutt and the politics in the interstices of that organization is something I never got too interested in. And of course, it'd be an interesting question. Rob, maybe you should get into some other line of work and become a primary dealer. See if you can possibly qualify it. After all, you are Jewish, and Jews generally dominate.
It'd be fun to be the primary dealer who can't offload the assets, and now you're stuck with. Because I assume you buy it on credit. Like, how do you?
No. Well, the primary dealers are usually pretty smart. They obviously will bid. They will obviously pay. They probably already have deals set up. They will pay what what they think would be the price at which they can lay off most of these bonds.
So you got a commitment from Japan to purchase it basically at this. You're going in there and making sure you're not. Yeah, I get it.
Yeah. So in the case that you're mentioning, you asked, well, who are they buying the bonds from? The Federal Reserve, when they are purchasing bonds, just as they did when the Treasury had trillions in 2021, they were sold to the primary dealers, and the primary dealers knew, of course, must have known in advance that they were going to be laid off they were going to be laid off is not a good word because it means layoffs. They were going to be in turn sold to the Federal Reserve, and that's how the primary dealers would make their money. And of course, they make a little bit of money on the spread. They what they pay for bonds, or what they buy when they buy bonds. It usually includes, once they turn it around, a profit that they make on the transaction. But again, I'm not sure of your story. You're talking about money from quantitative easing.
I gotta, I guess, do some homework and come back with a better version of that question. I must have just had that wrong.
Well, I guess you can say certainly a whole lot of people do hold treasuries, and I guess if they're selling, I'm not sure. I'm not clear. But in any case, as I say, I thought quantitative easing was a tempest in a teapot. But getting back to that, to that inverted yield curve, the argument was being made by those who believed the quantitative easing was successful, that the 10-year was being pushed down artificially by quantitative easing, and that's why the yield curve was inverted. However, if you notice on the chart, the negative territory of that yield curve, you see how like, I forget, it was like 3 years of being in negative territory before it went positive. I think you can see just from that chart, because it spans from 20 to 2025, it was quite a long time for that thing to be inverted.
And this is from not the gas producer, but someone letting us know that it appears that in the first round of quantitative easing, a lot of it went to the mortgage-backed securities.
Oh yeah, no, it does but mortgage-backed securities are, of course, backed by Fannie and Freddie. Yeah, so indeed, as I said, the quantitative easing does involve treasuries, and it does involve mortgage-backed securities, and so that part is true, and in that sense, so it was trying to keep the mortgage interest rate low. That's part of the story as well, but it doesn't buy AAA corporates. It doesn't buy junk bonds.
Excellent.
At least not yet.
All right, Gene, this was a pleasure. We're going to have to do a follow-up episode soon. It'll be a little shorter on less of my financially oriented questions.
That's not all I know, but let's see. The reason to abolish the Federal Reserve, again, is not because it causes inflation. The reason to abolish the Federal Reserve is that taxes are bad enough, but at least we feel them. As Milton Friedman said, that the real tax burden of the federal government is measured by how much it spends, because how much it spends is what it's really taking from us, not how much it actually taxes us for. And much of that spending is it wouldn't be able to keep that going if it didn't have a central bank. And that central bank is indeed helping to pay for the wars, because the mandatory spending is so high, the federal government would not be able to pay for those wars if it didn't have a Federal Reserve to back it up. And so that's why it's an evil institution, and that's why it was created. But of course, the government printing money, taking the people's money supply, is a story that goes back for centuries. It's just the central banks have lent it some respectability and institutionalized the ugly practice. But it happened in the 19th century in other ways as well. The main thing we have to do is to liberate money from the control of government and bring it back to the free market. And that's, in a way, what distinguishes Austrian economists, Ron Paul as well, Dave Smith, Robbie the Fire, from the mainstream economists who think that the Federal Reserve can be reformed. It can never be reformed. It will always be under the thumb of the Treasury, and the Treasury will always use it in order to finance its operations when it needs money, and that will probably lead to double-digit inflation sometime down the road. And so let's end on that pessimistic note, Rob. And because the politicians are doing nothing about it, they probably don't even understand what I've just explained to you, and that's tragic. That, to my mind, is, of course, the greatest indictment of government is the sort of thing you and Dave talk about most of the time, and that Dave debates: government's wars. I can talk about price controls and the harm that does, but our wars, that kills people, that maims people. That's the major libertarian issue, and I commend you and Dave for talking about it so much, and Dave especially for stepping into the debate ring with so many about those issues. Happily, he's a very learned student of Scott Horton.
All right, Gene, always a pleasure. Great to download some of the actual information on all these things I'm typically just bullshitting about. So thank you once again for doing it, and we'll do another one soon down the line.
And let me take you out for a Big Mac, $10.89.
There you go. Still affordable with the fries.
Doesn't cost
with the fries and a drink.
Doesn't cost $32, as Dave once said. That's probably because he's got so goddamn much money, he only goes out to expensive restaurants.
There you go.
$10.89 for the Big Mac, the fries, and the Coke.
There you go.
Talk to you soon.
All right.